Hey everyone, welcome back to Corporate Decoder, the place where we take those confusing corporate filings and turn them into something you can actually understand. Today, we're diving into a Form 8K from SYNOPSYS. I know, sounds like a snooze fest, but trust me, there's some juicy stuff in here, including a peek at their big acquisition plans. It involves numbers, future predictions, and as always, a healthy dose of corporate risk assessment. Let's decode. SYNOPSYS, a company you might not have heard of, but that's crucial in the tech world, is gearing up to acquire Ansys. This Form 8K is basically a status update, giving us the financial nitty-gritty of both companies as they move towards this merger, with information regarding their most recent financial records. We're talking audited financial statements from Ansys and some projected numbers from SYNOPSYS that give us a combined picture. Why should you care? Because mergers this big reshape industries, and this one promises to change how software and hardware design come together. First up, we get a look at Ansys's books. These are the real, audited numbers, giving us a solid understanding of where Ansys stands financially. We're talking balance sheets, income statements, cash flow statements, everything you'd expect to see when a company is getting ready to be bought. A quick glance at Ansys's consolidated balance sheets reveals that their total assets for 2024 stood at around $6.1 billion, a slight increase from the previous year, and their total liabilities are around $2.1 billion. This gives them a relatively strong equity position. Also, their 2024 revenue was around $2.4 billion. Now, SYNOPSYS gives us their view of the future with what they call pro forma financial information. These aren't actual results, but educated guesses of what the combined company might look like after the merger. It's like a financial what-if scenario. Remember that these numbers are not set in stone. They are based on certain predictions and could be different from the actual results after the acquisition. For example, they are estimating the impact of the merger on their balance sheet as of January of 2025, including the effects of any related transactions. They're also giving us an idea of how the combined operations might perform, looking at the year that ended in October of 2024 and the 3 months that ended in January of 2025. It's important to remember that this report isn't changing SYNOPSYS's previously reported financial results, such as those in their annual report or quarterly report. It's adding to them, giving us a more complete picture of what's happening with this acquisition. All of this new information adds and changes information that SYNOPSYS previously shared when they filed paperwork for the merger with the SEC in April of 2024. The Ansys information we talked about came from Ansys's annual report for the year ended December 31, 2024. As always, there's a section dedicated to forward-looking statements. Basically, they're saying, hey, we're making predictions about the future, but things might not go as planned. It's a way for the company to protect itself from lawsuits if their predictions don't come true. These statements are about the future, and they're based on current expectations and assumptions. That means they could be wrong because lots of things can change. Here come the disclaimers and reality checks. The filing lists all the things that could go wrong, which could impact SYNOPSYS's and Ansys's businesses and stock prices. It includes everything from regulatory hurdles to economic downturns to simply not integrating the two companies well. Key issues include whether they can complete the deal on time, get all the needed approvals from governments, and secure financing on acceptable terms. There's also the risk that something might happen that causes them to call off the merger altogether. The merger itself could create problems like disrupting business relationships, increasing competition, and making it harder to keep or hire important people. It could also distract management from running the day-to-day business. There's a risk of lawsuits related to the merger, and that SYNOPSYS might struggle to combine Ansys's operations and products successfully. It's also not guaranteed that SYNOPSYS will achieve the financial results and other benefits they expect from the merger. A big concern is whether SYNOPSYS can handle the extra debt from the acquisition and pay it down as planned. The deal might also trigger issues with existing contracts. External factors like the economy, the health of the semiconductor and electronics industries, and actions by governments could also affect SYNOPSYS and Ansys. Finally, while the merger is pending, both companies might be limited in what they can do, which could prevent them from pursuing certain opportunities. The report emphasizes that while they've listed many potential risks, there could be other unforeseen issues that make their predictions inaccurate. Finally, we get to the end of the report signed by John F. Runkle, Jr., General Counsel and Corporate Secretary. So, what does it all mean? SYNOPSYS is making a big bet on the future by acquiring Ansys. The deal has the potential to create a powerhouse in the software and hardware design space. However, as this report makes clear, there are plenty of risks. Integrating two large companies is never easy, and the current economic and regulatory environment adds even more uncertainty. From my perspective, I think this acquisition has the potential to be a game changer for SYNOPSYS. Combining their expertise with Ansys' simulation and analysis tools could create a more compelling offering for customers. However, the success of the deal will depend on SYNOPSYS' ability to manage the integration process effectively and navigate the various risks outlined in this report. The total assets and revenue of Ansys looks good, and if they can keep the combined liabilities under control, SYNOPSYS should see a successful acquisition. Thanks for watching. If you found this breakdown helpful, be sure to like, comment, and subscribe for more corporate deep dives. Until next time.